Hey everyone, welcome back to Paisa Pathshala. If you've ever opened an app like Grow, Zerodha, or Money to look at mutual funds, you've definitely seen the letters NAV. It stands for Net Asset Value. But what does it actually represent? Does a lower NAV mean a cheaper fund? Let's clear that up today. Think of a mutual fund like a giant basket. Thousands of people like you and me pool our money into this basket. The fund manager takes this total pool of money and buys shares of companies like Reliance, HDFC Bank, or Infosys. The NAV is simply the price of one single unit of that basket. To calculate the NAV, the fund takes the total market value of all the stocks they own, subtracts the expenses they pay to run the show, and divides that by the total number of units held by all investors. So, NAV is essentially the per unit price of the fund at the end of the day. Here is a common myth: Fund A has an NAV of 20 rupees, and Fund B has an NAV of 100 rupees, so Fund A is cheaper. This is false. A mutual fund isn't like a shirt in a store. If you have 1000 rupee to invest, you will get 50 units of the first fund or 10 units of the second. Your total investment value remains the same. Think of it like buying gold. If you have 5000 rupees, you can buy a small quantity of gold, regardless of whether the price per gram is high or low. The NAV is just the price per unit. The real value lies in the performance of the underlying stocks the fund manager has chosen. Why do some funds have an NAV of 10 rupee while others are at 200 rupees? The difference is usually age. A fund that started 20 years ago has had more time for the value of its underlying stocks to grow. A brand new fund often starts at an NAV of 10 rupees during its NFO, or new fund offer. Does a higher NAV mean the fund is expensive to buy? Not at all. In mutual funds, there is no such thing as being overvalued based on the NAV. You are buying a percentage of the total portfolio. Whether the NAV is 10 or 1000, if the stocks in the basket grow by 10%, your investment grows by 10%. You might wonder, if NAV doesn't matter for the cost, what should I look at instead? You should look at the expense ratio. This is the fee the fund house charges to manage your money. A lower expense ratio is generally better because it means more of your money stays invested and grows. Also, check the fund's portfolio. Does it hold companies you trust? Does it fit your goals? If you are a student or a young professional, you might prefer an index fund which tracks the Nifty 50 rather than worrying about the NAV of a specific active fund. Remember, mutual funds are long-term vehicles. The daily fluctuations in NAV are normal, just like the daily ups and downs of the stock market. Don't panic when you see the NAV drop slightly. Focus on the consistent growth of your SIT over several years. So, here is your takeaway: stop comparing NAVs between different funds. Instead, compare the fund's historical performance, the risk involved, and the expense ratio. Invest based on your financial goals, not the current price of a single unit. Happy investing, and keep learning with Paisa Pathshala.